Hello everyone, and welcome back. My name is Greg Furman, and this is the Forex Weekly Outlook for the week of June the 6th, 2016. Now, to get started, we're going to begin where we always do with the US dollar index. The dollar coming off an absolute, basically a horrible unemployment report. But my concern with that report here is, the main concern I have is the ADP showed 170. We got 38K or something along that line on the payroll numbers. So there's a very wide discrepancy there. And I really do smell a bit of a rat here where, we're in political season. They could be holding back some of those jobs to put them back into September, October, and November when they need those big numbers. So I'm not saying that's the case. I'm just simply saying the ADP report is never off by that amount, by the amount that we saw on Friday. And of course, with that, the dollar has taken quite the hit. So the dollar is pulled back. The dollar is likely to see further weakness. Now, what we could see midweek is that some of the bigger money players here are taking the same opinion that I am, that there was something fishy about that employment number. So the key VantagePoint levels come in at 95.06, 95.14, and 94.86, excuse me, with a very bearish close of 94.02. Our neural index is down. Our predicted short, medium, and long-term differences are pointing down, as is our strength indicator. We have a crossover on the predicted MACD, however, still above the zero line. And of course, our predicted RSI 28.1 is signaling a trending move on the dollar. Now, we know, as I've talked about in a number of the last Forex Weekly Outlooks, I always make reference to our intermarket correlations. Guys, the dollar has been very highly correlated to these global equity markets, specifically the DAX, the Nikkei, and even largely to the S&P 500. So if the dollar is truly going to sell off, we are going to see the equity market. We need to see those global equity markets going down also. That will confirm that the dollar is going to be under pressure for at least the near term, which is next week. So right now, the S&P 500 failing again up at massive resistance here around 2110, simply cannot break through it. The key VantagePoint level comes in at 2078. That's the level we want to watch to begin the week here, guys. If we break through 2078, we close through there, close under that level, that tells me the dollar is going to move lower. The Nikkei is going to move lower. The DAX 30 is going to move lower. That'll put pressure on the US dollar against most of your European pairs. The Swiss franc, I don't know about Great Britain. We'll talk about that one in a minute. But the euro, the Swiss franc, the yen will likely come under pressure. These are your main players here. So when we look at this right now in the S&P, we are moving into overbought territory. Our neural index is still saying that we potentially could be going higher. But our long-term predicted difference here from VantagePoint at 76, we can see the last time we hit that level, right around 80, we had a pretty substantial sell-off on the S&P 500. So when we look at this and we drag this over so we can see this, I'll also point out that, it was at the end of the month when that happened. So right now, keep an eye on your upper levels at 2010 to see if we can break through to the upside. But if we start breaking below the key VantagePoint level of even, say, 2080, rounding it off, then we're likely going to see the global equities move lower. Of course, the same would apply to the DAX. The trend line that I drew in for last week continues to hold, which again is putting upward pressure on the euro. Now, this intermarket correlation between the euro and the DAX 30 is substantial, guys. Basically, if the DAX is going down, the euro-US currency pair is going up. That is what you need to know and understand when you're trading Forex, when you're trading futures, equity futures. The currencies are driving the equities and vice versa. So the intermarket correlation we know right now is that if that DAX continues to move lower, then the dollar is likely to move lower. The euro currency is likely to move higher, the Swiss franc higher, maybe even the British pound higher. We'll have to wait and see on that one with the Brexit. But the other very strong intermarket correlation here, of course, too, is oil. Oil right now is moving. It is not moving inverse to the U.S. dollar, despite what some of our analysts are saying. That's not really true here, guys. What the intermarket correlation right now is oil and our RBOB gasoline contracts are actually moving with the dollar. So when I look at this, to solidify that point, what I can do is I can bring this up and I can look at my direct intermarket correlations with the US dollar index. Now, when I do this, it basically gives me a very clear visual as to what I should be looking at. So when we look at our direct intermarket correlations here side by side, we can see that as oil has been moving up in the month of, basically in the month of, the better part of the month of May, that the US dollar is following those oil contracts. An indisputable fact here, guys. That is what's happening. We can see that as the dollar took a big hit on Friday, so did oil. Okay, so this is very important that we monitor these types of intermarket correlations, because they're very, very important, and most people miss them. We can see it with the RBOB gasoline contracts, the same thing, that they're actually moving together. I agree, they normally move inversely, but they are currently not really doing that. In actual fact, we can see here the RBOB gasoline contracts were a leading indicator, not a lagging indicator, a leading indicator for what was going to happen with the dollar. Very important. We can see with the Nikkei here with the dollar. Once again, these are indisputable intermarket correlations that are driving the market here. You can see that as the dollar started to rally, okay, we can see that went up. So did the Nikkei, right? So somebody, if you're trading dollar yen, guys, how can you not be looking at the Nikkei? You need to be. That's the main thing to understand. Nikkei is going up, dollar yen is going up. Nikkei is going down, dollar yen is going down. That is the direct intermarket correlation here that we need to see. The same as the DAX. For the most part, these are moving together. The DAX and the US dollar index are going up together. Okay, so these are very, very important intermarket correlations that I not only do I like to talk about on here, but I talk about them also with my own direct clients. And this is a very important thing to monitor, because an intermarket correlation will trump just about everything else on the screen. So it's just good that you know these things. Same as gold. We can see that gold here has made a big move up on a Friday, but we're still coming off a significant downward move. We've paused here at the 1200 mark. If gold keeps moving higher, the euro currency will keep moving higher, guys. That's the key thing. You're looking for gold moving higher, and you're looking for the global equity markets moving lower, which will indirectly support the euro currency. So when we look at the euro currency firsthand, now that we know our direct intermarket correlations, if we're trading euro US, guys, before we ever take a trade, we always look to see what the DAX is doing, to see what the global equities are doing. So our key vantage point levels for next week, longs are favored here off 112.23, or basically 112.23, 112, and the 112.56. We've closed at 113.66, a very bullish move. The top of our trend line resistance comes in at the 116 area. It is very likely we are heading to this area based on that payroll number. But just remember what I've said. There's that wild card there, that was a somewhat of a bogus number, and it was politically manipulated. So just keep that in mind. But for now, I do expect the euro to pull back to at least the 112.56 area, where we can look at picking up longs. Now, our neural index is fully supportive of that. We can see our predicted MACD crossing up, and our predicted RSI, again, just at the breakout point, 71.3. We should see further euro strength after a modest pullback. Now, the same next week will apply to US Swiss franc. We've got a new trend line is going to form in here. I'll just draw it in here so everybody can see it. That's coming in just under the parity level, about 99.60. Selling into that area is a very reasonable play for next week. And again, you know, I do expect a retracement here. Our retracement levels are 98.45, 98.77, and 98.35. We have a very bearish close of 97.56 below all three of the key vantage point predicted moving averages. So again, what we're looking for is a minor retracement here back up towards this 98 area, 98.30, in order to set our shorts. Shorts will continue to be in play while below the key vantage point level 98.45, and more importantly, below the 99.50 level, this upper trend line that's been in place for several days now. Now, as we move into our additional pairs here, the British pound, the best advice I can give with this particular pair for next week here, or the entire month of June here, guys, we have a BRE exit vote on June the 23rd, I believe it is. I'm already getting notices from the brokers that they are increasing margin requirements right across the board. Now, I would personally stay away from this pair for a couple of weeks until we get past this major event risk. And the reason I say that is when a broker warns that they're increasing margin requirements, that means they may not be able to fill stops. So even though you have a stop on your trade, we all know what happened with the Euro Swiss franc pair when the Swiss National Bank removed the peg. It was an absolute disaster. Don't put yourself in that position here, guys. Be very careful with this. Right now, we have pretty solid trend line support at the 144 level, but basically this pair was heading lower. The only thing that saved it was the non-farm payroll number on Friday that was incredibly weak. So the Neural Index is saying, yes, we've got some upward strength, but my bigger concern with this particular pair is the additional indicators from VantagePoint are still saying we are going lower, despite that absolutely horrendous payroll number on Friday. The indicators from VantagePoint are saying we still could be going lower here, guys, okay? And the wild card's the Brexit. So watch this level next week right here, 145.14. The key VantagePoint 18-day predicted EMA, we can see we did not close above that level. So 145.14, that's the pivot area to begin the week. Below it, we're short. Above it, we're long. But again, my optimism on further upside on this particular pair prior to the Brexit vote remains heavily guarded. Now, with the dollar yen, I had talked about this last week, or over the last several weeks, that basically there was something very fishy about this pair also, that the S&P 500 was moving up aggressively, yet the dollar yen was at a standstill. It remained at a standstill. We had a big spike up on the holiday Monday of this past week, only to turn around and crash some 400 pips right afterwards. So this is why trading in holiday thin markets, you have to be very cautious, because oftentimes it's not a true price. So our triple EMA cross here is completed. Our predicted short, medium, and long-term differences and our neural index strength indicator all pointing down. The predicted MACD, the position of the VantagePoint predicted MACD is troublesome to say the least. It is right on the zero line. Our predicted RSI has already gone lower. This triple EMA cross here, this is all warning of a much bigger move coming to the downside. Now, what will trigger this, guys, is the S&P sells off. If the Nikkei continues to move lower, the dollar yen does not stand a chance. You know, maybe the Bank of Japan could try their intervention tricks again. I don't think it's going to work, though. This pair is likely heading to the bottom part of this range, down in this 105.50 area. We can reassess at that time, but the VantagePoint indicators right now across the screen are all telling us that, you know, we should remain short on this particular pair, and I fully agree with that particular assessment, to be clear. Now, as we come into our main commodity, but I will stop for a second here and come back. 109.30, 109.14, 108. 108, these are all your upward key pivot points. In order for this move on dollar yen to reverse, we have to clear 109.30. I just don't see that happening next week here, guys, so keep that in mind. So moving on to our commodity-based currencies with the dollar CAD. Now, the dollar CAD is not necessarily going to feed off of that dollar weakness. Now, like I've shown everybody here, right now the dollar is following oil prices. The dollar is following gasoline contracts. That's what's happening. So if that's the case and oil starts moving lower with the dollar, that is actually going to weaken the Canadian dollar. So we've got some pretty heavy support down to the 128 here to our former swing low. We've closed below the current trend line. The key VantagePoint levels, 130, 139, 130.14, indisputably we've had a very bearish close, but in most cases when we see a big move down, a big bar down like that, it very seldomly has any follow through here. So again, be cautious with this one, just thinking that this is an easy short, when in actual fact it may not be. There could be a long hidden in here. So we're going to see how this one starts the week. Right now, the VantagePoint main indicators, the predicted differences, the neural index, the strength indicator, they are pointing down. They are not oversold. They have room to extend, but watch out around the one. If we even get to 128, be careful down around that area. For confirmation of this, I'm looking for the predicted MACD moving below the 0 line, and I'm looking at the predicted RSI breaking below the 40 level. Now again, you'll notice that I use these the RSI, and more importantly the predicted RSI, very differently. I'm not using it for an overbought or oversold condition per se on a regular basis. I do look at that, but I'm looking for where it is above is it above the 50 or below the 50, and I'm looking for a break of 40 or a break of 60 to say that the market has momentum here. It's going to build. So we can see numerous cases of this where the predicted RSI is broken below the 40 line, and if you look at this section in here, that led to basically a 500 pip move lower on this particular pair. So if I can break below this area, and we can see it on the upside here too, as the predicted RSI broke the 60 level, we had a pretty significant move of about 400 pips to the upside off of this signal right here. So we'll continue to monitor this one, but for now, shorts carry a very slight edge here, but as long as only while we're below 130 here. If we get back up above 130, that means chances are that oil contracts are plummeting, and just because the dollar's weak on that, because of that, doesn't mean it's going to be weak against the Canadian dollar or some of the other commodity blocks. So the other two main commodity block currencies we look at is Aussie US, New Zealand US. Now, once again, the main deterrent here is that non-farm payroll number that sent this pair higher. We were moving higher most of the week. I wholeheartedly believe that somebody knew that payroll number long before it came out. The dollar yen sold off aggressively 3 days before we got the non-farm, before we even got the ADP report here, guys. So, I smell of a bit of a rat here. Now, right now the Aussie will feed off of those. If gold continues to push higher and the metals push higher, the Aussie will push higher too. But if we have a significant risk-off event and those equities start plummeting, that very well could drag Aussie US and New Zealand US down with it. So we look at these indicators from VantagePoint, our predicted MACD pointing higher, predicted RSI 60 is 70.7. A lot of these indicators are saying that that the Aussie is going to push higher. So the key level we want to watch here, 72.82 to start the week. We've closed at 73.65. The additional key pivot areas, 72.61 and 72.96. We need to stay above mainly 72.82. So you can see we've closed above that key vantage point level, but not by a lot. So 72.82. Watch that like a hawk to begin the week, guys, because not only could there be a good long, but there could be a fantastic short, and again, in a risk-off environment. The same thing will apply to New Zealand US, and again, when we look at Aussie US and New Zealand US, they're virtually the same trade. They're going more or less up and down together. So when I look at that New Zealand pair, 67.95, 68.07, 68.62, we've closed at 69.54. So we're above all those key levels, but we need to stay above these levels in order to keep a bullish bias. Now, I would expect a retracement on Monday and Tuesday, and at that time we can assess if we want to remain long. Right now, the indicators from VantagePoint are suggesting there's a long bias here, okay? But again, there's some other factors at play because of that non-farm payroll number that could really send a shockwave through the markets to start the trading week. So in that particular case, what I would say is, what I would say to my own direct clients is basically ease into the market here, guys. Be careful on Monday. We should see the real price Tuesday, Wednesday. We will see the real price on the dollar, the euro, the yen. We will see it all then. It's just like anything else. We certainly want to remain patient in our trading.